A lot of real estate people talk about the incredible potential that real estate has on building wealth, and it creates this buzz and excitement because yeah, it is exciting. However, not many people talk about the income required in order to buy a home. Unfortunately, it's not as simple as just going to the bank and saying, yeah, of course I can afford it. You need to be able to prove that you can afford it based on the bank's requirements. So in today's video, I'm going to go over those requirements as well as how much home you can actually afford based on your income level. It's important to understand that what a bank says you can afford may be vastly different than what you think you can afford. And a great way to understand this is most financial gurus will tell you to spend no more than 10% of your income on a car payment. That's great advice, but what about for the people that don't spend any money on Starbucks and never go out to dinner? They always cook at home. Those people may want to spend more on a car payment because that's what they're choosing to prioritize. So what financial people say you can afford may differ from what you think you can actually afford. But when it comes to buying a house, it doesn't matter what you think, it only matters what the bank says. The bank is going to consider statistics and risk because remember, when you get a mortgage, when you take out a mortgage, you're taking out a loan. The bank is lending you money, so they're going to want to make sure that you're able to pay that money back. If you make $5,000 a month and your mortgage payment is $4,000, there's not a whole lot of room for error. So the bank isn't going to be certain that you can actually make that payment each month. So the biggest thing that's going to determine how much home you can actually afford is your debt to income ratio. It sounds complicated, but trust me, it's not. All debt to income ratio means is how much of your income is going towards debts each month. So that's things like the mortgage, that's things like car payments, student loans, credit card payments, and any personal loans you may have. As you can imagine, the lower the debt to income ratio, the less debts you're paying off each month. If you had a debt to income ratio of 100%, that means that all of your income is going towards paying off debts each month. So in an ideal world, we want to have a debt to income ratio as low as possible. Now, there are two types of debt to income ratios. There's front end and back end. Front end is the mortgage. How much does that take up of your income? It's just the mortgage, that's front end. Back end is the mortgage plus everything else. So the mortgage plus the car payments, student loans, credit cards, personal loans, all of that combined, how much does that take up of your income? So for a conventional loan, banks want to see a front-end DTI, debt to income ratio, of 28% or less. And they want to see a back-end DTI, debt to income ratio, of 36% or less. So for example, if you make $5,000 a month, we're going to take that and multiply it by 28%, 0.28, and that gives us $1,400. So in general, that's the maximum monthly mortgage payment you'd qualify for with a conventional loan. Now, including all other debts, your DTI has to be below 36%. So $5,000 times 36% is $1,800. So if the mortgage takes up $1,400, that only leaves an additional $400 for all of your other debts. If your other debts take up more than $400, then your mortgage payment will have to be less than $1,400 to stay below that total 36%. So how much house can you actually afford? Well, if we use that same example, $5,000 a month in income, that's 60 grand a year with 20% down, because this is a conventional loan, with our current interest rates, you'd be able to afford a $215,000 home. With an income of $100,000, you could afford a $400,000 home. With an income of $150,000 a year, that could get you a $625,000 home. But remember, all of this is with 20% down because these are conventional loans. How about we check out FHA loans? With FHA loans, they require you to put less money down, and the debt to income ratio requirements are less strict, meaning they have higher ratios. FHA loans have a 31% front-end DTI and a 43% back-end DTI. So because the DTIs are higher, it helps more people get qualified. So how much house can you actually afford with an FHA loan? Well, if you made $5,000 a month times 31%, that's the front end DTI, that gives us $1,550. That's in general the maximum monthly mortgage payment that you could qualify for. But keep in mind, with FHA loans, you only have to put 3.5% down, and the less you put down, the higher the debt to income ratio is going to be. So with a $60,000 annual income and 3.5% down with current interest rates, you could afford a $190,000 house. So it's less house than with the conventional loan, but with the FHA loan, you only had to come up with $6,650 for the down payment. The conventional loan, you had to come up with $43,000. With an income of $100,000, you could afford a $350,000 home with an FHA loan, and with a $150,000 income, you could afford a $540,000 home. But the question everyone wants to know is, how much do I have to make to buy a $1 million home? Well, it's actually pretty easy. We just have to work backwards. A $1 million home with 20% down, that's $200,000, would have a monthly mortgage payment of $5,445. If we divide that by the front end DTI, 28%, that gives us $19,446. That's how much you'd have to make every month in order to qualify for a $1 million house. If we divide that by 28%, the front end DTI, that gives us $19,446. That's how much you'd need to make each month in order to afford a $1 million home. That's why it's helpful to have a two-income family, because in that case, each spouse would have to make $9,723 a month. As home prices continue to increase, it's easy to get discouraged and think, how in the world am I ever going to be able to afford a home? It can seem challenging and frustrating, but I want to encourage you, don't get too discouraged. It's absolutely possible, but it's going to require some sacrifice. I had a video go viral of me talking about using FHA loans as a way to get into real estate, and a lot of the comments were using home prices as an excuse to not even save for a down payment. That's absurd. Regardless of home prices, if you can't even come up with 3.5%, it doesn't matter. So instead of being concerned with home prices, focus on setting money aside each month so that you have the money for a down payment. The housing market goes through cycles, and so the goal is to be setting money aside so whenever the market goes through a dip or we go through a down market, you'll be ready to buy. And for everyone saying that we're just going to continue to see skyrocketing growth, that's just not the case. The housing market goes through cycles, and we see long periods of growth followed by long periods of more static to slight appreciation. Start saving so that you're ready to buy when we see that pullback. And as always, please make sure to like and subscribe, and I'll see you in the next one.